Good morning and welcome to the Forex Daily Update, brought to you by Pepperstone on Friday the 5th of April 2019. I'm Darren Sinden, and you can follow me throughout the day on Twitter by following @ds_Pepperstone. Okay then, let's take a look at the overnight changes and price moves to be aware of. A relatively quiet session as far as the global foreign exchanges were concerned yesterday. Still some key points to flag. However, first of all, the British pound against the US dollar, the cable rate. The British pound trying to make gains, adding 0.13% against the US dollar yesterday, and taking its weekly gains to 0.23% thus far. In terms of the Australian dollar against the US dollar, somewhat more successful, gains of 0.16% against the US dollar overnight, taking its weekly gains to 0.63%. So not actually shaping up to be a bad week for the Australian dollar, and that perhaps is against what you might have felt, or your intuition, shall we say. In terms of other movers, dollar yuan, the Chinese currency, improving slightly against the US dollar. The dollar down by 0.07% on the day. The weekly gains are probably the thing to concentrate on here, though 0.37% to the good, the Chinese currency against the US dollar. Of course, this currency will be very sensitive to any developments on US-China trade talks. Elsewhere, the Brazilian real taking 0.43% off of the US dollar to take its weekly gains to 1.22%. And the dollar index broadly unchanged on the session, marginally lower. Better on the week, up by 0.12%, but really marking time, I think, ahead of some crucial US economic data out later today. Speaking of economic data, what's on the calendar? Events that may move the markets today? Well, let's take a look. I've just thinned the calendar down to the most important high-impact events for sake of brevity. So first of all, to flag, we have a Eurogroup meeting ongoing in Brussels today. We've already had leading economic index data for February out of Japan, a slightly better read there, so some crumbs of comfort perhaps for the Bank of Japan and Shinzo Abe. To come at 6 a.m. GMT, we'll have industrial production data out of Germany for the month of February. That data, of course, following hard on some very poor factory orders data earlier in the week. We pause then until 12:30 GMT, cross over the Atlantic for the main event of the day, which is, of course, the March Nonfarms payrolls, including average hourly earnings, unemployment, and labour force participation rates, if I can actually get that out. In terms of forecasts, we're looking for 180,000 new jobs created versus that shockingly low 20,000 figure from last month. As far as earnings are concerned, no change really. We're looking for hourly growth of 3.4%. The unemployment rate for March anticipated to stay at 3.8%, and the labour force participation rate, rather interestingly, is expected to drop to 62.9. So let's see what happens there. In terms of other data today, well, at the same time as the US release, we have the Canadian unemployment data for March. It's always overshadowed, of course, by the news from its larger neighbour. Nonetheless, it's important to keep an eye on this data as it does feed directly into Bank of Canada policy. Okay then, breaking news and comment that's caught my eye overnight. And first of all, close but not there yet was President Trump's verdict on US-China trade talks. So no summit between himself and President Xi of China, and the talks will continue today in Washington and presumably for some while to come yet. Meanwhile, Japanese household spending rose by 1.7% in February, data reveals. However, that was below forecast for a gain of 2.1% and lower than January's 2% print. At the same time, cash earnings in the country also fell for the first time in 18 months. Staying in Asia Pacific, Australian construction PMI even improved in March to 45.6, up from February's read of 43.8, but that was still well below the long-term average of 46.41. Perhaps rather concerningly, new orders for apartments fell at their sharpest rate for almost 6 years. So the construction business in Australia is still struggling, although looking at that long-term average, it's more of a slow car crash than any kind of major bleed outs, it would seem. Okay, let's look at food for thought then, something to take away with you into the trading day and beyond. And why not think about this? I've drawn two charts here just to try and provide some clues as to what we could expect or might expect from today's non-farm payroll releases. The first of our charts here plots US continuing jobless claims, so longer term US jobless claims against initial or new jobless claims. What we saw yesterday was a continued fall in the number of initial jobless claims, and this to multi-decade lows. So that, of course, a very bullish signal about the number of unemployed people in the country. It doesn't necessarily mean that there are lots of new jobs being created, but it does mean that perhaps unemployment, or might mean that perhaps unemployment is falling. The continuing jobless claims, they're down, but they're still elevated compared to the levels we saw in the autumn of last year. And our second chart plots the ADP employment changes, a private sector read, if you will, on job creation in the USA against the non-farm payrolls number. The ADP data was out yesterday. It showed, and this is the blue line, it showed a slowing rate of job creation, in line, I guess, with that sharp fall in last month's payroll numbers. Remember that you might be interested to know that last month the ADP data suggested that there were going to be 183,000 new jobs created in the USA, and even bigger miss to the actual figure than the non-farm payroll consensus forecast of analysts. So I'm not sure we can read too much into that, but the runes perhaps suggesting that we'll see new jobs created perhaps at a slower rate though than we've previously been used to. For my own intuition, I think we will see a positive number, but one perhaps below the 180,000 that the market's forecasting. Okay, it's risk warning time. Please do take a moment to read this risk warning. Trading CFDs and foreign exchange on margin can be a risky business. If you're in any doubt about those risks or the suitability of leverage products for you, then please do take the time to contact your Pepperstone account representative, and do, as I say, read this risk warning thoroughly. Thank you very much for your time today.